Louis Vuitton and Rolex simultaneously go bankrupt in China. Nikon is completely banned. Evergrande also announces bankruptcy. China's economy falls into chaos. The economic downturn in China has had a profound impact on the luxury market, with major global brands like Louis Vuitton and Rolex facing unprecedented challenges. Louis Vuitton, a renowned symbol of luxury and prestige, has long enjoyed a dominant presence in China. However, as the country's economy continues to falter, the once booming demand for high-end goods has significantly diminished. The financial strain experienced by the middle and upper classes in China has led to a drastic reduction in discretionary spending, with luxury goods becoming increasingly unaffordable and unnecessary for many consumers. This sharp decline in consumer purchasing power has left Louis Vuitton in a vulnerable position, struggling to maintain its previous sales levels. Recent years have seen the luxury sector thrive in China, with Louis Vuitton being one of the top players in the market. However, the economic crisis has altered the landscape, and Louis Vuitton is no longer insulated from the broader financial woes afflicting the country. With inflation rising and the cost of living increasing, Chinese consumers are shifting their spending priorities towards essential goods, leaving little room for indulgence in luxury fashion. The loss of this critical consumer base, which once drove the brand's exponential growth in China, has forced Louis Vuitton to reevaluate its strategy in the region. Stores in major cities like Shanghai and Beijing, once teeming with shoppers, are now facing a downturn in foot traffic. The empty boutiques stand as a stark reminder of how quickly fortunes can shift in the luxury world. Similarly, Rolex, the iconic Swiss watchmaker, has not been immune to the economic crisis sweeping through China. Known for its timeless designs and meticulous craftsmanship, Rolex has long been a status symbol among China's wealthy elite. However, as the economy worsens, even the most affluent consumers are reconsidering their purchases. The demand for luxury timepieces has plummeted, with Rolex watches, once coveted as a sign of success and wealth, losing their appeal in a time when financial stability is more important than ever. The company has seen a significant drop in sales, forcing many of its authorized retailers to slash prices in an attempt to attract buyers. For Rolex, the situation in China is particularly dire due to the brand's reliance on the country as one of its largest markets. As consumer sentiment in China sours, the once flourishing demand for luxury watches has dissipated. In response, Rolex has had to halt its aggressive expansion plans in the region. Many of its stores are struggling to remain profitable, and the economic pressures on Chinese consumers have resulted in a surplus of unsold inventory. The very essence of what Rolex represents, timeless luxury and unrelenting quality, has come under scrutiny, as fewer people are willing to invest in such high-ticket items. The broader economic implications of these struggles for Louis Vuitton and Rolex cannot be understated. The collapse of luxury sales in China highlights a deeper issue: the economic instability that now grips the country. As Chinese consumers tighten their belts, global brands that once thrived on the spending habits of China's affluent classes are now feeling the pressure. For these luxury giants, the Chinese market has long been a cornerstone of their success, and the sudden downturn in sales has caused shockwaves throughout their operations. The situation underscores the fragility of China's economic recovery and casts doubt on the future of luxury retail in the country. Louis Vuitton and Rolex's struggles also reflect a broader shift in the luxury market in China. As economic conditions continue to deteriorate, brands that once relied on Chinese consumers are now grappling with the reality that their business models may no longer be sustainable. For years, luxury brands have tailored their marketing efforts to appeal to China's wealthy elite, but the current economic environment has forced a re-evaluation of these strategies. With fewer people able to afford such high-end products, brands like Louis Vuitton and Rolex must adapt or risk further losses. Moreover, the downturn in the luxury sector is symptomatic of the larger economic challenges China faces. The ripple effects of a slowing economy, rising inflation, and mounting debt are being felt across industries, with luxury goods being one of the hardest-hit sectors. The weakening of consumer confidence, particularly among China's wealthiest individuals, signals a troubling trend for both domestic and international businesses operating in the country. As consumers shift their focus towards essential items, the luxury market is left grappling with declining demand and a shrinking customer base. In summary, Louis Vuitton and Rolex's difficulties in China are not merely isolated incidents. They are emblematic of a larger economic struggle that is gripping the country. As consumer habits shift in response to worsening financial conditions, the once lucrative luxury market is now facing significant challenges. For brands that have long relied on Chinese consumers, the road ahead is uncertain, and their future success in the region will depend on their ability to navigate the turbulent economic landscape. The recent ban on Nikon in China marks another significant blow to the country's tech ambitions, highlighting the escalating tensions between China and international technology providers. Nikon, a leading Japanese corporation known for its advancements in imaging and precision technology, has been instrumental in providing cutting-edge equipment for semiconductor manufacturing. However, China's latest move to ban Nikon entirely from the market is a clear indication of how the nation is attempting to further isolate itself technologically in pursuit of self-sufficiency, particularly in the highly competitive semiconductor industry. For years, China has depended on foreign technology to develop its semiconductor capabilities, and Nikon has played a pivotal role in supplying the lithography machines necessary for producing advanced chips. Lithography, the process of printing intricate patterns on silicon wafers to create semiconductors, is a critical step in chip manufacturing. With Nikon as a key supplier, China has managed to make considerable advancements in the production of semiconductors despite U.S. restrictions on certain high-end technology exports to the country. However, the decision to ban Nikon from selling its lithography machines to Chinese manufacturers signals a dramatic shift in the country's approach, as it intensifies its efforts to reduce dependency on foreign technology. The decision to impose this ban comes at a time when China is aggressively trying to bolster its own semiconductor industry. In an environment of increasing global tensions, particularly with the U.S. over technological supremacy, China has sought to shield its tech sector from external pressures by investing heavily in homegrown innovations. Yet, the reality is that China still lags behind global competitors like Taiwan and South Korea in terms of semiconductor production capabilities. The ban on Nikon, while aimed at promoting Chinese alternatives, may ultimately hinder China's progress in closing this gap, as domestic manufacturers do not yet possess the same technological expertise or equipment sophistication. The immediate consequences of this ban are profound. For Nikon, China represented a significant market for its lithography machines, and the loss of access to this vast consumer base will undoubtedly affect the company's global sales. More critically, for China's semiconductor manufacturers, the loss of Nikon's advanced technology is likely to cause severe disruptions in their production processes. China has been actively working to produce chips at the 7 nanometers and 5 nanometers nodes, critical benchmarks for modern semiconductor technology. But without access to Nikon's high-precision equipment, these ambitions could be delayed significantly. While China has been pushing for domestic alternatives, its efforts are still years behind the technological capabilities offered by established companies like Nikon. Furthermore, the ban reflects broader geopolitical tensions. The rivalry between China and Japan in the tech industry has been long-standing, but in recent years, it has intensified as both nations compete for dominance in high-tech sectors. Japan has historically been a key player in providing China with the technology it needs to grow its semiconductor industry. But this ban is likely a response to broader diplomatic and economic strains between the two countries. By cutting off access to critical Japanese technology, China is sending a message that it is willing to take drastic measures to protect and promote its domestic tech industry, even at the risk of slowing down its own progress. This move also underscores China's broader strategy of tech nationalism, wherein the government aims to replace foreign technology with domestically developed alternatives. While this may be a long-term goal, the immediate impact of banning companies like Nikon could be far more damaging than beneficial. As China's semiconductor industry struggles to keep pace with global leaders, the loss of Nikon's technological expertise will likely hamper the nation's efforts to become self-sufficient in chip manufacturing. The global semiconductor industry is incredibly complex and requires a level of precision and innovation that takes decades to develop. Without access to world-class suppliers like Nikon, China risks falling further behind in this critical race. In addition to the direct impact on the semiconductor industry, the ban on Nikon is indicative of the increasing isolation of China's tech sector from the rest of the world. As the nation seeks to decouple from foreign technology providers, it faces significant challenges in maintaining its growth trajectory. The reliance on foreign expertise, particularly in high-tech fields like semiconductor manufacturing, has been a cornerstone of China's rapid technological advancement over the past 2 decades. By severing ties with key international partners, China may inadvertently slow down the very progress it seeks to accelerate. The loss of Nikon's technology is particularly concerning given the current global shortage of semiconductors. As countries around the world grapple with chip shortages that have disrupted industries ranging from automotive to consumer electronics, China's decision to ban Nikon could exacerbate these issues. With fewer suppliers capable of meeting the demand for advanced semiconductor manufacturing equipment, China's ability to produce the chips it needs to remain competitive in the global market may be compromised. In conclusion, the ban on Nikon from the Chinese market represents a significant escalation in the country's push for technological independence. While it aligns with China's long-term goals of reducing reliance on foreign technology, the short-term consequences could be severe. For Nikon, the loss of one of its largest markets will be a major financial hit, but for China, the impact on its semiconductor industry could be even more profound. As the nation continues to prioritize self-sufficiency in technology, the decision to exclude global leaders like Nikon may hinder its progress, leading to further economic and industrial setbacks in the years to come. The announcement of Evergrande's bankruptcy has sent shockwaves through the Chinese economy, marking a dramatic turning point for one of the nation's largest property developers. Once regarded as a beacon of success within China's booming real estate sector, Evergrande's financial struggles reveal deep-rooted issues within the industry and the broader economic landscape of the country. With debts exceeding $300 billion, the company has been unable to meet its financial obligations, leaving thousands of homeowners and investors in limbo and raising concerns about the potential for a cascading effect on the global economy. Evergrande's rise was meteoric, fueled by aggressive borrowing and a relentless expansion strategy that saw it become the second-largest property developer in China. However, this rapid growth came at a significant cost, and the company's reliance on debt began to unravel in the face of tightening regulations and a slowing housing market. The Chinese government's crackdown on excessive borrowing practices, aimed at curbing the mounting debt crisis in the real estate sector, has significantly impacted Evergrande's operations. Unable to sell properties quickly enough to service its debts, the company found itself in a precarious financial position, struggling to keep afloat amid a sea of red ink. The ramifications of Evergrande's bankruptcy extend far beyond the company itself. As one of the largest players in the Chinese real estate market, its failure has raised alarms about the stability of the entire sector. Property developers across the country are now bracing for a downturn, with many fearing they could face similar fates if they are unable to navigate the challenging economic climate. With construction projects stalled and a growing number of homebuyers demanding refunds for uncompleted properties, the sentiment of fear and uncertainty has gripped the housing market, leading to a significant decline in consumer confidence. Moreover, the implications of Evergrande's collapse resonate throughout the financial system. The company's extensive network of creditors includes banks, suppliers, and bondholders, many of whom are now left facing substantial losses. Analysts predict that the fallout could lead to a credit crunch, where lenders become more cautious in extending loans, further exacerbating the economic slowdown. The potential for a ripple effect throughout the economy is evident, as businesses that rely on Evergrande for contracts and payments could also face severe consequences. The Chinese government's response to the crisis has been scrutinized heavily. While there have been efforts to stabilize the situation through policy adjustments and financial support for distressed companies, the effectiveness of these measures remains uncertain. Observers argue that the government's previous stance on debt reduction and financial prudence may hinder its ability to respond decisively to Evergrande's downfall. Critics assert that a stronger, more coordinated approach is necessary to restore confidence in the real estate market and prevent further collapses in the sector. Evergrande's bankruptcy also underscores a larger narrative about the shifting dynamics of the Chinese economy. The once booming real estate sector, which has been a key driver of economic growth, now stands at a crossroads. With a growing number of households burdened by debt and an economy facing increased headwinds, the government must grapple with the reality of a housing market in crisis. The era of unchecked growth fueled by speculative investments appears to be coming to an end, as the country faces the sobering prospect of a more cautious and sustainable approach to development. As the dust settles from the announcement of Evergrande's bankruptcy, the future of China's property market remains uncertain. Investors and consumers alike are left to ponder the long-term consequences of this high-profile collapse. The intricacies of the real estate sector, once viewed as a surefire path to wealth, are now under intense scrutiny. With rising debt levels and tightening regulations, the path forward will require careful navigation and a re-evaluation of what constitutes sustainable growth in a rapidly changing economic landscape. The current state of the Chinese economy is one marked by turmoil and uncertainty, as a series of financial crises and policy missteps converge to create an environment of panic. Once a global economic powerhouse, China is now grappling with a multitude of challenges that threaten to undermine its position on the world stage. The collapse of major brands like Louis Vuitton and Rolex, alongside the devastating bankruptcy of Evergrande, illustrates just how far the nation has fallen from its previous status of economic confidence and expansion. These developments are not mere headlines. They are indicative of a larger pattern of instability that is sending shockwaves throughout various sectors of the economy. As consumers tighten their belts amid rising living costs and stagnant wages, the demand for luxury goods has plummeted. The luxury market, which once thrived on the spending habits of China's wealthy elite, is now in decline. The economic environment has shifted dramatically. The once prominent middle class is now grappling with financial insecurity, and as discretionary spending diminishes, brands that once flourished are finding themselves in a precarious position. This trend is not confined to the luxury sector alone. As the purchasing power of consumers wanes, industries across the board are feeling the pressure. Retailers and manufacturers alike are facing the brunt of reduced consumer confidence, leading to an alarming rise in unsold inventory and falling profits. The downturn in the real estate market, exacerbated by the collapse of Evergrande, has further contributed to the atmosphere of panic. Evergrande's monumental debts and subsequent bankruptcy serve as a glaring reminder of the vulnerabilities within the property sector. The implications of this collapse extend far beyond the company itself, affecting a vast network of stakeholders, including banks, investors, and homeowners. With countless construction projects halted and a significant number of homebuyers left in limbo, the real estate crisis is a ticking time bomb that threatens to explode further, dragging the entire economy down with it. Local governments, heavily reliant on land sales to fund their budgets, are now grappling with unprecedented fiscal challenges. China's once reliable economic engines, export growth, domestic consumption, and investment, are sputtering. The global economic landscape is evolving, and China's strategy of aggressive expansion through debt and investment is no longer sustainable. The shift in consumer behavior, coupled with a tightening regulatory environment aimed at controlling debt levels, has created a perfect storm that is suffocating the economy. As a result, the government is now faced with the Herculean task of stabilizing a floundering economic system while managing public expectations and maintaining social order. Moreover, the government's response to these crises has been hampered by its previous policies. Years of prioritizing rapid growth over stability have left local authorities in debt and ill-prepared to deal with an economic downturn. As the central government scrambles to implement measures to stimulate growth, the effectiveness of these strategies remains in question. Many economists argue that without significant structural reforms, the government's efforts may be little more than band-aids on a much deeper wound. In this environment of uncertainty, fear is palpable among investors and consumers alike. The stock market has been volatile, with indices reflecting the growing unease surrounding China's economic prospects. Investors are reassessing their positions, leading to sell-offs and further losses in the market. The absence of a clear path to recovery is sowing doubt, and many are questioning whether China can regain its footing in the global economy. The narrative of a China miracle is now being replaced by one of caution and skepticism. The prospect of widespread layoffs and rising unemployment exacerbates this already fragile situation. As companies downsize or shutter operations altogether, the potential for social unrest grows. The psychological impact of financial instability cannot be understated. When people fear for their livelihoods, their spending behavior shifts drastically, creating a self-fulfilling prophecy of economic decline. The ripple effects of this uncertainty are felt across various sectors, and the notion of a once booming economy is now tinged with desperation. In conclusion, the Chinese economy is currently navigating treacherous waters. The convergence of luxury brand failures, the catastrophic fall of Evergrande, and the overall loss of consumer confidence signal a profound crisis. As the nation grapples with the fallout from these events, the road to recovery appears increasingly fraught with challenges. Without decisive action and substantial reform, the potential for a prolonged economic malaise looms large, casting a long shadow over China's aspirations for a stable and prosperous future. The question now is not just about how China can recover, but whether it can redefine its economic model to adapt to a rapidly changing global landscape.